Today's number? 82. That's how many years late a book was returned to the San Antonio Public Library last week. When asked what took so long, the returner said she was, quote, checked out. An awful joke to start the show. Welcome to Prof G Markets. I'm Ed Elson. It is September 10th. Let's check in on yesterday's market vitals. All three major indices closed at record highs. That's the first time since December 2024 that they have all achieved that milestone on the same day. Treasury yields also climbed from their lows ahead of key inflation data. The producer price index will be out today, and the consumer price index will come out on Thursday. Apple stock fell 1.5% after a lackluster debut event for the iPhone 17. And finally, Oracle stock popped more than 20% to a record high on stronger than expected cloud growth projections. Okay, what else is happening? It's been a huge week for China, and a new world order is coming into view. We've seen the country look beyond the US for growth in August. China's exports to the US declined 33%, while those to Africa grew 26%. This shift extends to cars too. BYD's European sales increased more than 200% in July, and it's aiming to have 1,000 stores on the continent by year end. But it's not just business. China is also flexing its military muscle. Last week, of course, it staged a massive military parade with Vladimir Putin and Kim Jong-un in attendance. And on the diplomatic front, the Shanghai Cooperation Organization Summit drew more than 20 non-Western leaders, including India's Prime Minister Narendra Modi, on his first visit in 7 years. We have been covering these developments a lot lately on the program, but there is so much to unpack here, so much to get into. So we wanted to check in with someone who has actually been on the ground in China recently. So let's bring in our favorite China economist, Alice Hahn, to take us through what's happening. Alice, great to have you on the show again.
Thanks, Ed. Happy to be back. A little bit jet-lagged, but happy to be back and tell you what I saw in China the last few weeks.
We're very excited. And by the way, I just want to say welcome to the Prof G Media family. For those of you who don't know, Alice recently launched a China-focused podcast with Prof G, and you can check out that pilot episode on the Prof G pod. We can discuss that later. But first, Alice, Scott and I discussed this military parade on Monday's episode with Vladimir Putin in attendance, Kim Jong-un. They all walked down the red carpet together. You were in China leading up to that. Can you just tell us a little bit about what you saw and what you think this military parade really means for China?
Thanks very much, Ed. I was actually in Beijing during the week of the parade and left just as the parade was happening. What struck me was the optics of it. It was very clear that China was trying to strike two notes. One, to deter the US on any issue related to military affairs, including Taiwan. They were pulling out the big guns, metaphorically and literally. We had hypersonic missiles, high-grade equipment, drones. China was clearly showing the US and the rest of the world that it was ready for business and that it shouldn't be meddled with. Number two, I think it was very important, not just that Putin and, as you mentioned, Kim Jong-un of Russia and North Korea were there. You had a good showing of Southeast Asian leaders. And I think this was an important follow-up from what was happening at SCO, as you mentioned, Ed, in Tianjin, in the sense that China wanted to show that it had many friends that it could rely on trade and national security-related issues. I think it was important that you had a big showing of some of these Southeast Asian leaders, including leaders from Indonesia, to again show the rest of the world, including Washington, that China wasn't alone. And that it was actually increasing its diplomatic clout within the region and globally. I think those were the two important notes that they were striking. And then last but not least, I would say on the domestic front, we shouldn't discount that this was again showing muscle domestically and stirring nationalistic feeling. I think it was important to note, and I don't think this was covered in the Western media, that it was strongly encouraged by all Chinese companies within even private organizations that employees would take time off from work to watch the parade. Again, a sign of nationalistic pride that the party and Beijing is trying to stoke.
To what extent was this new behavior? I mean, we know that they've done these military parades before. We know that there's a lot of nationalistic pride in China, and they try to celebrate their heritage as much as possible. But from my understanding, this combined with the summit and all of the leaders that we saw there was a little bit more of a message, at least in terms of their connections and their alliances with other nations. I mean, what part of this was new compared to previous celebrations?
I think on two levels, this was quite novel. Number one is just the sheer scale of it. The fact that you had this military parade where you had a sheer enormity of high-grade military equipment on display. The performances by the male and female military officials as well as army, I think that representation on a symbolic and visual level was quite new. And number two, to your point, Ed, is the fact that they were able to bring these world leaders, strong showing from Southeast Asia, but the fact that you had the first multilateral meeting of Russia, North Korea, and China in one domain and at a Chinese military parade, I think was pretty novel. It's worth also mentioning that this is the first time we've seen a North Korean leader come to China for a military parade, I think since the late 40s. So in many, many respects, just from the sheer scale as well as the bringing together of these high-level officials, I think China was doing something quite new, and it was clearly doing this to, I think, again, project strength in advance of potentially future meetings between Trump and Xi.
Just shifting to markets, did any of this have any impact that we saw in terms of markets in China? Did this, I know the Hang Seng is doing very well right now, but I'm only looking at it on a year-to-date basis. What kind of impact did this have on the markets?
I would say it's a story of correlation, not causation. What struck me when I was in Beijing was the fact that virtually nobody was talking about tariffs. I was there in April, just after Liberation Day, and all the subject was revolving around tariffs. Everyone was talking about tariffs. This time around, they were talking about China's quote-unquote quiet bull market or even slow bull market. There was a feeling that the government, since the beginning of the year, has been allowing households to basically get more involved in the stock market and is trying to signal the right pro-private sector, pro-market messages to domestic investors and foreign investors. So we've seen a degree of Chinese household bank deposits being shifted into the stock market. We're also seeing more increased willingness on the part of foreign and domestic investors to get involved in the Hong Kong Stock Exchange as well as the mainland stock exchange. So in the end of August, we saw the stock rally on both the Hang Seng and the Shanghai Stock Exchange going up 30% year to date, rather. And I think that has been a sign that people are trying to do two things. Number one, they're seeing China as being quite resilient to tariffs, in fact, shrugging off some of the tariff risk. And we've seen that in the export data. And number two, China as being a hedge against some of the risks they see in the US. And even on top of that, I would say, as another bet on AI, I think what has become apparent is that it's a two-player field. Chinese valuations are extremely low compared to the Mag 7. And so for anyone looking to bet on AI future, China seems to be still a lucrative, interesting space. And that's why we've seen a lot of the growth being driven by companies like Alibaba that are at the forefront of the AI revolution in China.
Yeah, we talk a lot about country risk. Specifically with China, there is just this risk of it's a communist nation and, there's no guarantees that the CEO of a company isn't going to be disappeared from one moment to the next. And that is generally translated into lower multiples for all Chinese stocks. But as you say, up 30% on the Hong Kong Stock Exchange, which is, by the way, best performing index of the year so far. And you compare that to the S&P, which is up 11% year to date. I'm wondering, has the China risk conversation changed? Is there a reason why we're seeing higher multiples? Is that what is happening in terms of valuations right now?
I completely agree, Ed. I would also caveat, though, that Chinese valuations are were at an all-time low last year. So we're recovering from, I think, a considerable degree of weakness in Chinese stocks. And number two, to your point that you're referencing, what struck me is that the US is becoming what China was, I would say, in the 2020s, when you had investors concerned about the centralization of power, a great degree of policy uncertainty coming from the center government. And that's mainly driven by, I would say, top-down dynamics, where a leader is cracking down or injecting a great degree of policy uncertainty. And that has basically taken investors aback. I think we're seeing a lot of the pathologies and patterns that we saw in China in 2020 in the US. And that's, I think, pushing on the margin investors to look at China more fondly. And it's helped by the fact that Xi Jinping and Beijing have made a concerted effort, I would say, since last September, to again try to rev up private sector, to rev up the markets. Because structurally, and this is worth mentioning, Ed, even though I think cyclically we're entering a better cycle, we're entering improvement, structurally a lot of these problems still remain, whether it's local government debt overhang, whether it's underconsumption, overexposure to exports. I think a lot of these structural issues remain in play, but we've just seen an increased improvement in sentiment from the consumers and on the margin, the private sector. And it's largely been driven by, I think, a top-down loosening.
Chinese yuan also just hit a 10-month high against the dollar. I'm wondering, what is driving the strength of China's currency right now?
Well, fundamentally, this is a dollar weakness story, but it's also a story in which the PBOC is, I think, not intervening to devalue the currency. I think that has been driven by two things. Number one, is the US-China relationship. I think they are attentive to the fact that Trump wants a weak dollar, and that if Chinese currency weakens too much, this is going to derail ongoing US-China negotiations and trade talks. And number two, I think China is mindful of beggar thy neighbor policies. It is mindful of the fact that as the dollar weakens, if China weakens its currency against some of the other trade-weighted currencies, say the euro, for instance, or even the yen, this could create another wave of trade tensions and backlashes from some other countries in a period in which China can't afford to have more trade tensions. It remains ever yet more exposed to exports. And if the deficit between China and the US rather deficit with China has to decrease, which is what Trump wants, China needs to find alternative markets in the medium to long term. So I think that fundamentally we're in a stronger CNY period. And it wouldn't surprise me that if China decided to come to Trump at the end of the year with some kind of new Plaza Accord light in which there is an agreement that CNY remains elevated against the USD, that could be something on the table.
Yeah. One of the things you mentioned there in terms of just this massive run-up that we've seen in Chinese stocks is AI. On that point, China just released their AI Plus plan. And I'm just some of the statistics from this plan. The plan is for 70% of the country to be using. The plan is for 70% of the country to have adopted AI-powered devices and agents by 2027, and by 2030, they want that to be 90%. So my takeaway is they really are leaning heavily into AI. I just wanted to get your read on the AI plan for China. Are those numbers realistic? And what is their plan to achieve this?
Well, what struck me, Ed, on this trip was that everything was about AI. There was a great deal of optimism after DeepSeek domestically about China's AI capabilities. When I look at the previous, I think, 2 to 3 years, there was a degree of skepticism about whether or not China could catch up with the US. US was at the forefront of these frontier labs on the quest to AGI. That rhetoric has shifted because China feels more confident about its hardware capabilities on the semiconductor front, and because China feels as though there has been a real wind in the sails after DeepSeek in terms of investment in AI, in terms of government attention to AI, and in terms of even foreign interest in China's AI ecosystem. So I think right now they're betting on AI powering everything. I heard from multiple contacts in the business and even policy communities in China that AI was going to be what electricity was in the previous industrial revolution. And this is going to power basically every sector of the economy. It's even going to power governance. So governments are using ever increasingly AI systems and applications. For instance, DeepSeek is working, I was hearing, working closely with local governments and even central governments in using their AI algorithms and LLMs to power public governance. This is going to be the most important issue in the next 5-year plan that will be announced in October. And I fully believe that AI is going to be at the forefront of China's economic system moving forward. It's a top-down, bottom-up, I think, approach to the economy. It's going to have benefits, but it's going to have massive drawbacks. What was apparent to me was the fact that policymakers are extremely optimistic and positive about AI. I would say especially at the very, very top. And to some of my sources in the policy advisory community in China, there's a lot of apprehension about the impact of automation on jobs. The labor market is still looking pretty weak. Youth unemployment is increasing. There's a risk at which we have to note that automation and AI systems will actually structurally create more unemployment moving forward. But that's something that I don't think policymakers are caring about that much, because everything is about how great AI is and how it will transform everything.
Yeah. If I could sort of summarize my takeaway from this conversation and from what we've been discussing, I mean, from the display of strength and unity with all of those Eastern nations and those Southeast Asian nations that we saw at the parade and also at the summit, the alliance with the Prime Minister of India, the trade partnerships that are forming. I mean, for a long time, it felt like the Belt and Road Initiative was a big problem that everyone was worried about, and then it wasn't really working anymore, but it appears to be picking up some steam again. The massive run-up that we've seen in the markets, all tech stocks in China massively running up right now, the huge emphasis on AI, the strengthening of the currency against the dollar. In sum, China is back, is my read on it. It's been a few years where people said, the Chinese system wasn't really working. You had all of these structural issues. You had these real estate problems. You had the issues with the labor market. But my sense is 2025, China is kind of coming back. I'm wondering if you think that is the right characterization.
I think it is, Ed. I would caveat, though, that a lot of those structural issues that you mentioned, the real estate, debt, demographics, which we haven't talked about, they are still very much entrenched in the system and have not changed. I think the real change is the fact that people can't afford not to invest in China. China
Right.
is going to be a big incubator and applicator for AI. It continues to be ever more efficient when it comes to exports. We haven't mentioned this, but what struck me was the fact that in China, a lot of the rhetoric is about involution or anti-involution. Basically, another form of Chinese overcapacity that is pushing down cost and effectively meaning that Chinese goods get ever cheaper, both in the domestic and foreign markets. So China is becoming even more efficient as an export machine, and that has implications, obviously, globally, but it means that China, at a private sector level, still remains extremely, I would say, important. And I think that investors feel as though the real top-down sentiment has shifted. Xi Jinping and the leadership is understanding of the importance of the private sector and financial markets. And I think that release in the political risk has been really important since last September for foreign investors especially to come back in, albeit I would say slowly. And I think last but not least, again, I think that the government is attentive to the fact that households need a place to build wealth. They're not going to do it in the real estate sector because they're unwilling to amp that up again. Where else can they look? And I think that in the short term, they're looking rather than boosting wages, for instance, they're looking at the stock market as an answer to this. So I foresee upside. I don't say a huge bull run, but I would say, again, as mentioned previously, a quiet or a slow bull is well and truly baked in the cake.
Alice Hahn is a China economist and director at Greenmantle. Alice, your first official episode of the new podcast, I believe it airs next Tuesday. Is that right?
Correct. With James King, I'm very much excited to join the discourse. A lot of exciting things, as we mentioned on this call, that are happening in China.
Very, very exciting. You can check that out on the Prof G Pod. Alice, always very insightful. We really appreciate your time.
Thanks so much, Ed. Take care.
We'll be right back. And if you're enjoying the show so far, be sure to like and subscribe to the Prof G Pod YouTube channel at the link below.
Support for the show comes from Vanta. Are you a startup founder or security professional? If so, you're going to want to listen up. Navigating vendor security requirements can be challenging. Facing your first security compliance audit can be downright scary. With Vanta, it doesn't have to be. Vanta is a trust management platform that helps businesses automate security and compliance, enabling them to demonstrate strong security practices and scale. Simply put, your company can't grow if it can't prove that it's meeting security standards, including SOC 2, ISO 27001, and HIPAA. Vanta can get you audit ready in weeks instead of months, saving you up to 85% of associated costs. And Vanta scales with your business, helping you continuously monitor compliance, unify risk management, and streamline security reviews all in one place. More than 10,000 global businesses trust Vanta to achieve compliance and save them time while they're at it. Starting and running a business is hard. Let Vanta help make it a little bit easier. Go to vanta.com/markets to meet with a Vanta expert about your business needs. That's vanta.com/markets. Support for the show comes from public.com. You might already use AI tools to refine your emails and streamline your workflow, so why not see if it can optimize your investing as well? For that, you can check out public.com. Public.com is the investing platform that takes your money as seriously as you do. With Public, you can build a multi-asset portfolio of stocks, bonds, options, and more. You can also access industry-leading yields, including the 4.1% APY you can earn on your cash with no fees or minimums. But what sets Public apart? AI isn't just a feature, it's woven into the entire experience. From portfolio insights to earnings call recaps, Public gives you smarter context at every touch point. And the best part? You can earn up to $10,000 when you transfer your existing portfolio over to Public. Go to public.com/ProfG to fund your account in 5 minutes. That's public.com/ProfG. Paid for by Public Investing. All investing involves the risk of loss, including loss of principal. Brokerage services for U.S.-listed registered securities, options, and bonds in a self-directed account are offered by Public Investing, Inc., member FINRA, and SIPC. Complete disclosures available at public.com/disclosures. Support for the show comes from Grüns. An apple a day keeps the doctor away, yada, yada, yada. The truth is that even if you enjoy fruits and vegetables, it can still be tedious to get all the nutrients your body needs. So here's a tip: add Grüns to the mix. Grüns isn't a multivitamin, a greens gummy, or a prebiotic. It's all of those things and then some at a fraction of the price. And bonus, it tastes great. All Grüns daily gummy snack packs are vegan, nut, gluten, dairy-free, with no artificial flavors or colors, and they're packed with more than 20 vitamins and minerals, with more than 60 nutrient-dense ingredients and whole foods. And for a limited time, you can try their Grüni Smith apple flavor just in time for fall. It's got the same snackable, packable, full-body benefits you've come to expect, but this time, these taste like you're walking through an apple orchard in a cable-knit sweater, warm apple cider in hand. Grab your limited edition Grüni Smith Apple Grüns, available only through October. Stock up because they will sell out. Get up to 52% off when you go to gruns.co and use the code MARKETS.
We're back with Prof G Markets. The job market may be even weaker than we thought. New data from the Bureau of Labor Statistics showed that between March 2024 and March 2025, the US economy added 911,000 fewer jobs than previously reported. The original number was 1.8 million. Put another way, that means the economy created only half as many jobs as we once thought. Now, to be clear, these backward-looking revisions are standard practice at the BLS. After the initial data is reported, more data comes out, specifically unemployment tax records, which they then sift through, and then they go back and they revise the initial number. So that is standard here. The part that isn't standard is how big the revision was. In fact, this was the largest revision to the jobs numbers of all time. Now, as expected, we have seen fierce political responses on both sides. Remember, this revision is covering mostly Biden's presidency, but also a couple of months of Trump's presidency. But overall, it makes Biden's numbers look not so great. So on the left, you have people saying that these revision numbers are made up. They're lying. The BLS is lying to make Biden's final months look bad. And then on the right, you have people saying that the original numbers are lying. The BLS was lying about the economy before, and now they have to go back and revise those numbers to the real number. Now, I want to be clear. These revisions and the size of these revisions are a problem, and they are part of a growing trend. We are increasingly seeing larger and larger revisions to the jobs numbers. In fact, this time last year, we saw what was the largest revision to the jobs numbers in over a decade. That is a problem. If you can't trust the data when it comes out, if the data is swinging wildly up and down 6 months later, that basically means your data isn't very good. That's an issue. But to look at that data, to look at that revision, and to immediately default to the BLS is lying, as the president has done countless times, not only is that a lazy reaction, it's also a stupid reaction. It actually doesn't make any sense. First off, just think it through logically. If the BLS wanted to lie about the jobs numbers, it would make no sense to lie on the original number and then go back and tell the truth on the revised number. If you wanted to lie about the job numbers, you would just lie on both numbers. You'd lie on the original number and you would lie on the revised number. You'd lie about all of it. So this notion that they are lying and then going back and telling the truth, it's completely ridiculous. It doesn't even make rational sense. And that is also why firing the BLS chief on accusations of lying is so stupid. Now, having said that, how do we explain why these revisions are getting so big? How do we account for the fact that the reporting from the Bureau of Labor Statistics has clearly gotten worse? Well, there is a boring answer. 2 statistics explain all of this. The first statistic. Since COVID, the response rate to the BLS's current employment statistics survey, that is the survey with which they calculate all of this data, the response rate to that survey has fallen nearly 20%. In other words, right now, the BLS is working with a fifth less information than they used to. That's the first statistic. Statistic number 2, and arguably the most important one. Over the past 2 decades, the BLS's budget has fallen more than 20%. In other words, while the economy has gotten larger, more dynamic, and more complex, the agency tasked with measuring that economy has seen its resources dry up. In fact, since the mid-2000s, the BLS's workforce has shrunk by nearly a fifth. So that means you've got fewer people making calls, fewer people upgrading the methodology and upgrading the technology, fewer people following up with the businesses that don't respond to those surveys. Put another way, the reason the BLS's data is getting worse isn't because they're lying. It's because they don't have the resources. They don't have the money and the staffing and the technology to do their job properly. It's the same reason why any other organization would underperform. Now, here's the kicker. The president has made his opinion very clear. He thinks the Bureau of Labor Statistics is lying. And so what is his solution to that problem? Well, number one, fire the commissioner. We saw that. But more importantly, number two, cut funding even more. Yes, the 2026 budget is going to cut BLS funding by an additional $56 million, and it's going to reduce the workforce by an additional 8%. That is his fix for the agency that is already resource constrained and already struggling to do its job. It's not lying, it's struggling. And this is a playbook we have seen over and over again, and we are seeing it once more. You accuse an American institution of corruption or some form of mismanagement. You then cut their funding and you take their resources. You watch them struggle and you wait for them to inevitably make some sort of mistake. And once they do, you pounce on them for political reasons, you accuse them of corruption again, and you cut their funding again. Rinse and repeat, rinse and repeat. And keep doing that enough times. And eventually, you're left with an institution that is so deprived of resources, so bereft of any power, any authority, that you can simply take it over and assume the power yourself. Coincidentally, what is next on the president's BLS agenda? Well, he is installing a guy named E.J. Antoni as its chief. Who is E.J. Antoni? Well, this is someone who has said publicly that the election was stolen from Trump. This is someone who has made violent threats against people who stood in Trump's way. This is someone who called the BLS a random number generator. As our friend Professor Justin Wolf has put it, E.J. Antoni as BLS commissioner would be, quote, disastrously terrible. Why? Because he has, quote, demonstrated no commitment to truth. That is the guy who is going to turn the BLS around. So this is how the playbook goes. And we are watching it play out in real time with the nation's top statistical agency. And the worst part about all of this, it's all going according to plan. Thanks for listening to Prof G Markets from Prof G Media. If you liked what you heard, subscribe to our YouTube channel and tune in tomorrow for more.